Joining us to talk more about that is Matthew Harrigan. He's a Bloomberg Best analyst on Time Warner Cable. He rates the stock a hold, which he downgraded from a buy in January, and just today downgraded his price target on Time Warner to $75 a share from $80. So, Matthew, welcome to the show. Thanks for joining us. Let's first talk about why you knock your price target down. Does it have to do with this deal?
Well, I think the first effect is really the way we do our price targets are geared off the S&P level. So I'm using a more conservative 1,200 bogey on the S&P, but I also do feel that this is a pretty full price for a low-growth asset, that being Insight.
So you don't see any advantages here, because we were talking on the conference call this morning about how they could possibly take on Hulu and Netflix, but you say we're getting a little bit ahead of ourselves on that.
Well, it's not a matter of taking on, Hulu and Netflix. I think the big issue for all the cable MSOs is really the anemic household formation in the United States and the competition from Verizon, Fios, and AT&T. Anecdotally, HBO did a study, and they looked at HBO usage in Netflix homes, and it was actually higher. So I think there's some cord cutting, there's some cord thinning, but it's really the economy and the traditional, competitors, and as you talked about earlier, mobile internet as well, where the cable MSOs are not quite as optimally positioned.
Hang on. So you're saying people who use Netflix or Hulu, they also watch more premium cable television. What's that say to you?
Well, it certainly shows that maybe people are watching too much TV. Maybe that's why there's a weight problem in the United States. But no, I think that it tells you that there's just continued demand for linear TV content, really in all forms. I think accessing it on a traditional basis within the home, as well as over the top and even increasingly outside the home.
Hey, Matthew, it doesn't sound like you're too keen on this deal. You've got a hold on the stock. I mean, is it possible, depending on how this plays out, that you could see this name becoming a sell pretty quickly? Because you don't sound very happy here.
Certainly not at this level. I mean, this is a good company. I think they need to be a little bit more proficient on the operating side, and certainly, particularly this year, for the bonus tax depreciation, there's ample cash flow, and they're returning that cash flow to shareholders. But the trap here, of course, is you could even draw a parallel to some of the European PTTs, where there's very heavy capital return and not a lot of growth. And I don't think it's going to necessarily debilitate into that type of posture, but it's something to be concerned about. I'd like to see better operating execution, as well as financial engineering and the horizontal M&A we're seeing here for a relatively low growth asset.
Hey, Matthew, what would you rather have seen the company do with their money? They've been on, a pretty aggressive share repurchase. Should they have just done more of that, or something else in your view?
Well, basically, if you include the value of the NOL and you include about $100 million in cost savings over the next 2 years, they're basically buying the inside in, pari passu, equal if they're trading multiple. So you can argue that you've got an immediate window right now to buy in some stock. Of course, you couldn't buy in $3 billion worth at this level. I would just really like to see the company do a better job of blocking and tackling in some critical markets like Manhattan, where there is very heated competition from Verizon, Fios, and other players as well. I think they've done a great job in the capital execution strategy, but I just want to see better blocking and tackling. I think all the cable MSOs had a fairly suspect June quarter, but I think over the last 18 months, 24 months, they haven't executed as well as Comcast or Cablevision Systems, despite Cablevision's lackluster Q2.
Hey, Matthew, all those companies, Comcast, Cablevision, Time Warner Cable, none of them have, obviously, a national mobile network, and we've been talking a lot about mobile being really it here. Do they need to survive in this? I mean, AT&T and Verizon, are they stronger players because they can offer that triple, maybe quadruple play?
I think particularly Verizon is. I'm not enamored with the AT&T UVerse product on the terrestrial side, but it's a differentiator. People in the past have been very concerned about cable companies burning a lot of money on wireless. I think that issue was put to bed, and now it's somewhat resurfacing. Some of the MSOs like Cablevision have done a very good job on the Wi-Fi side, so I'm not completely dissing them. But I think that the arrangement with Clearwire has shown itself to be somewhat inadequate, and it certainly is an issue that I think is more and more raising its head going forward.
Hey, Matthew, just one last question here. So what are you going to be watching for in terms of Time Warner as it relates specifically to this deal? What do you need to see that you think, okay, maybe it's going to work out here?
Well, I don't have any issues with the math of the deal. I mean, this is a pretty low growth asset, 2% sales OCF growth in the last quarter. They had some execution issues with the Adelphi assets that they got a few years ago, but this is a very well managed asset. And I think just, doing the plain vanilla, programming cost reductions and such, they should be able to do that fairly easily. I mean, the issue is, to me, this is a sort of, the ennui kicks in here. This is a pretty, plain vanilla horizontal deal. And I think what they really need to do is just get their customer rep up better.
Going to leave it on that note. Matthew, thank you so much. Our thanks to Matthew Harrigan joining us to talk about that Time Warner deal.